Most retail traders start with the exact same textbook. They memorize cute names like Hammers or Haramis and wait for these specific candlestick shapes to appear on their screen. But relying on a single shape to make a financial decision is a trap. You spot what looks like a textbook reversal candle. You enter the trade feeling confident. Almost immediately, the market snaps back in the opposite direction, stopping you out. The issue is that an isolated shape means nothing on its own. Professionals don't stare at a single bar. They read the cumulative momentum of the entire surrounding trend. The market does not care what you call a candlestick. Price action is simply a real-time record of a psychological war between buyers pushing momentum and sellers reaching exhaustion. This is why your perfectly timed textbook entries constantly fail. You get stopped out, taking a minor loss, and then, just a few minutes later, the market turns exactly the way you originally predicted. To actually survive these traps, you have to stop looking for a magical single bar. You need to start reading the cumulative strength of the market to see who is actually in control. Trading happens in a gray zone where nothing is perfectly clear. By ignoring the retail obsession with shapes and tracking the structural footprints left by institutions, you put yourself on the right side of the probability. When a strong trend finally pauses, the immediate temptation is to buy that very first pullback. It feels proactive, like you are catching the exact moment the market turns. The math looks incredibly appealing. Getting in early means you secure a highly favorable price, and you can keep your protective stop very tight. But a strong trend rarely ends on the first try. The initial momentum usually carries so much weight that betting against it right away results in a massive probability of failure. This diagram shows exactly how retail traders are trapped. They buy the first dip. The trend resumes, hitting their tight stop losses, fueling the trend higher. Expanding, we see the institutional alternative, the bar counting edge. Smart money waits for a second attempt, a high 2 or low 2, before committing. This highlights the structural gap between entries. A high 2 is an algorithmic requirement. Institutions demand a definitive second signal before risking capital. Waiting for this confirmation forces a compromise. You have to accept a worse entry price, and your protective stop must be placed further away from that entry. Because your stop is wider, your risk per share increases. To manage that risk responsibly, you have to trade with a smaller position size. You are giving up size and price, but in exchange, your probability of actually securing a winning trade goes up dramatically. You align your entry with institutional timing. Sacrificing that perfect entry price is not a penalty. It is the mandatory cost of admission to avoid retail traps and secure institutional-grade probability. Sometimes the market enters a tight microchannel. This happens when the price moves decisively in one direction, bar after bar, with intense, concentrated momentum and almost no overlap. Eventually, a large trend bar will break the boundaries of this channel and close near its absolute extreme. This is an institutional signal bar. Buying the breakout of this specific bar places you in the market at the exact moment the always-in direction officially shifts from one side to the other. Executing this tactic generates extreme emotional discomfort. Because this confirmation bar is usually a climax bar, you are forced to buy high, right when human instinct screams that it is too late. Almost immediately after that climax breakout, the market will experience a multi-bar pullback. The institutions that initiated the massive move are taking their algorithmic profits. Surviving this immediate pullback is a psychological endurance test. You must endure temporary unrealized losses and trust the structural shift you bought into will hold. Every strong trend eventually dies. To predict this exhaustion, we map the market using a forensic blueprint called the spike and channel sequence. This diagram shows the first phase, the spike. It is a sudden, violent, one-sided burst kicking off a new trend. Next, we map the channel. We draw architectural boundary lines showing the upper and lower limits of the slower, overlapping stair-step progression that follows. Look closely where the price finally breaks that lower boundary. This formation reveals the market transitioning from aggressive institutional buying into hesitant, two-sided trading. By simply waiting for the price to break the channel's established trend line, you can accurately predict that the overall trend is facing imminent exhaustion. But channels are notoriously dangerous. They possess the frustrating ability to persist far longer than logic or standard mathematical indicators dictate. If you attempt to fade a channel, trading against it before seeing a definitive third push and a structural break, you will suffer death by 1,000 scalps, slowly draining your account. Recognizing the spike and channel life cycle protects you. You stop fighting an established trend, committing capital only when structural evidence proves the momentum is dead. There is no holy grail indicator in trading. Every single execution is a constant, unforgiving negotiation between your entry price and your probability of success. This decision tree outlines two distinct execution profiles, depending entirely on how you handle that negotiation. Path A is the system optimizer. This is the trader who swings with the established trend. If you take this route, you ignore all reversal attempts. You wait for tight microchannels to establish, and you strictly buy high-2 pullbacks. The trade-off is that you have to accept significantly wider stops. You will sit through the psychological fog of deep, uncomfortable pullbacks, but you secure a much higher overall win rate. Path B is the institutional shadow. This is the reversal hunter. Here, your job is patience. You avoid the temptation of the first pullback entirely. You wait for a mature spike and channel, a definitive third push, and a strong institutional reversal bar. You will execute far fewer trades overall, but when you do, you capture the violent asymmetrical vacuum effects that happen when a true market turn occurs. The market is a real-time forensic crime scene. Stop guessing the culprit based on the shape of a single candlestick and start tracking the undeniable structural footprints left behind by the trend.